Understanding what credit really means when it comes to real estate. Credit is basically the ability to borrow money from lenders, like banks or other financial institutions, to pay for things you want to buy. In real estate, this often means getting a loan or mortgage to buy a house, apartment, or any kind of property. Instead of paying the full price with your own cash, you use borrowed money. Then, over time, you pay back that loan with interest. Now, why would you want to borrow money to buy a property? The answer is simple: leverage. Leverage means using something small to control something bigger. In this case, using a small amount of your own money plus borrowed money to buy a property worth much more. This way, even if the property's value goes up just a little, you can make a big profit on the money you put in. Here's an easy example. Imagine you want to buy a house that costs $100,000. You only have $20,000 saved. Instead of waiting years to save the full amount, you get a loan for $80,000. You use your $20,000 as a down payment. If the house value goes up to $110,000 and you sell it, you make $10,000 on top of your original $20,000. That's a 50% gain on your money. If you had paid cash, your return would only be 10%. But there are some things to keep in mind when using credit for real estate. First, lenders look at your credit score, income, and debt before giving you a loan. A good credit score means you are more likely to get approved and get better loan terms, like lower interest rates. So, it's smart to check your credit report and fix any errors before applying for a loan. Second, think about how much you can realistically afford to borrow and pay back. Just because you can borrow a lot doesn't mean you should. Loans come with monthly payments and interest, so you need to make sure your income can cover these costs. Otherwise, you risk missing payments or even losing the property. Third, pay attention to the kind of loan you choose. There are different types, like fixed-rate loans where your interest stays the same, or adjustable-rate loans where it can change over time. Some loans require bigger down payments but have lower interest rates. Learn about these options and pick what works best for your budget and plans. Now, let's talk about how to use credit smartly in real estate investing. One way is called buy and hold. You buy a property with a loan, rent it out, and use the rental income to pay off the loan. Over time, the property's value grows and your loan balance goes down. After many years, you own a valuable property almost free and clear. This creates steady income and builds wealth. Another way is fix and flip. You borrow money to buy a property that needs work, fix it up, and sell it for a higher price. This can bring profits faster but comes with more risk because of repair costs and market changes.